The US dollar has just recorded its worst performance since 1973, falling more than 10% this year, and major institutions, including Morgan Stanley, expect the dollar weakness to continue. Now, at first glance, that might sound far-fetched. Yes, the US dollar index has weakened this year, but when we zoom out to the last 15 years, we can see that the dollar is still trending higher. In fact, today the dollar sits around the same level it did a decade ago, so it means the dollar hasn't lost much of its value, right? Well, it depends largely on what you measure it against. See, the dollar index measures the dollar against other currencies like the euro, British pound, and Japanese yen. But if those currencies are all losing value too, the index can stay flat even while everything else gets more expensive. To really see what's happening, you have to measure the dollar against something that actually holds its value, like gold. This chart, for example, shows gold priced in US dollars, and as we can see, it does not look very stable. Back in 2010, $1,000 could buy 1 ounce of gold. Today, it barely buys a quarter of that. We can see a similar pattern in housing prices. In 2011, the average US home cost around $180,000. Today, it's more than $430,000, over twice as expensive for a similar house. When a currency loses value, it takes more of that currency to buy the same goods and assets. That's what inflation really is, the mirror image of currency weakening. In fact, this decline in currency purchasing power has played a major role in shaping stock market performance too. Since 1980, the S&P 500 has returned more than 6,000% for its investors. But once we adjust those returns for inflation, the real return drops to just around 1,000%, nearly 6 times lower. So much of what looks like market growth is actually the reflection of a weaker dollar over time, a slow-motion version of a reverse market crash. But the question now is whether this trend could accelerate, as it did in countries like Turkey and Argentina, where inflation and weak currency eventually overpowered real market gains.